Hi there, and welcome back to the Energy Flux podcast. I'm your host, Seb Kennedy, founding editor of Energy Flux, the energy newsletter analysing natural gas markets through the lens of Europe's net zero journey and global geopolitics. This is a very special walking, talking podcast filmed live here in Gastech on the final day. It's been an intense week, and I just wanted to give a little tour of the exhibition, although it is in the middle of shutting down, as you can see, while talking through some of the themes that have been discussed at the event, some of the conversations I've been having with people behind the scenes, and the kind of the vibe, if you like, because I feel like this was a really momentous event on many levels. We had a huge US presence, political and commercial. There was so much floor space taken up by the US LNG crowd, and a lot of that floor space used to be taken up by Gazprom and the Russian contingent. Instead, we had the likes of Next Decade and Cheniere and Venture Global with these massive pavilions, which I'm going to see if I can show you if I walk over to the other hall here. And we had not one, but two American Secretaries of State. We had Doug Burgum, the US Secretary of the Department of the Interior, and Chris Wright, the US Energy Secretary, on stage doing a kind of double whammy, if you like. They did a press conference where they took questions from the press. They sort of tag teamed all of the kind of most difficult questions, if you like. They were very much prepared, and I'll talk a little bit about some of the things they said. Of course, there was just this enormous push to sell US LNG into Europe, and I think the jury's out on exactly how successful that's going to be, although there has been a huge amount of deal making. What we haven't seen here, notably, was a huge amount of European buyers signing binding SPAs with American LNG exporters, although that's not to say it won't happen, and there have been deals leading up to the event, and I'm sure there'll be more deals coming down the line. Let's see if I can walk through Next Decade, because they took a final investment decision on Train 4, I think it was, of their Rio Grande LNG project, and they have excellent coffee. These guys are great. The cafetiere, I mean the coffee makers, they're excellent. Here's Venture Global, whose CEO Mike Sable had some really quite extraordinary things to say, I might add. He took to the stage to make all these arguments about how there's not going to be an LNG glut, how prices won't come down if there's oversupply. It really was kind of flying in the face of economic reality. There's that old phrase about how it's very difficult to convince somebody of the truth when their salary is contingent upon them doing the opposite. That phrase sprang to mind when I was watching Mike Sable speak, because he was just saying, no, look, if there's a little bit of excess supply, then we just don't subscribe to the view that prices will come down, which is just economics 101, really, isn't it? But then in the same breath, he would say, prices, they could come down a bit, but if they go down low enough, then there's essentially unlimited demand at low enough prices. And I was left thinking, well, what's that price then, Mike? Because is it like minus $10 per MMBTU? Because how low do gas prices have to go for demand to be infinite? He said, if you can generate electricity for 6 or 7 cents per kilowatt hour, then you're just going to have unlimited demand. And I thought it's interesting that he used electricity as the example of his kind of low price equals infinite demand argument, because in Europe we have negative pricing on an increasingly frequent basis when wind and solar generation exceeds demand, and you have no residual demand on the system, and prices go negative. So I don't know if Mike Sable is aware of that, if he chooses to ignore it, but I think this is very telling that you get so many statements being said from the stage here which really don't seem to acknowledge reality. I do feel like the public statements this is, like the big exhibitors who also, all of whom are trying to obviously sell their wares, they just don't want to seem to just acknowledge anything really, that there could be any problem coming down the line from this kind of humongous wave of LNG oversupply which is baked into the system, on top of which you've got additional capacity volumes entering the market in the late 2030s from the deals being done here at Gastech in the lead up to Gastech, and inevitably in the weeks and months that follow we'll see more deals, more investment flowing into more capacity additions, all of which is going to kind of deepen the glut itself and prolong it into the 2030s. Because before this event I was very much of the view that the IEA says I could be a glut until 2040. I thought that was a little bit extreme, but the likes of Rystad were very bullish and said there'll be barely any glut at all, and we need to worry about the kind of undersupply in the 2030s. And I thought, well, that was excessively bullish, and so I was kind of like, well, I think there's going to be a glut. It's going to be deep, but it'll probably be mopped up by 2030. But now I'm having second thoughts, and I'm really thinking that if all these projects come to fruition, big if, mind you, because there are lots of reasons why they could fail, but if they do, then we could be veering more towards the IEA perspective on this, which is that there could be a very deep glut for a very long time, which goes like well into the 2030s, which has huge repercussions for gas and electricity markets the world over. So let me just kind of gather my thoughts here for a second. Well, what does that mean? Significantly lower for longer gas prices. I think that, and I have a theory, which is, because obviously all this investment is still flowing into the liquefaction side. Why would you do that if it's going to depress margins for longer, if it's going to reduce the attractiveness of those LNG investments? Why would you keep putting more money in? Would you not want to see kind of how the current expansions that are already baked into the system, how are they going to pan out? But no, apparently not. Everybody wants to do a deal now. So there's a few reasons why I think the deals are going through, kind of in spite of the kind of mountainous expansion that's already coming down the line. I think a lot of it is driven by politics, because it's not always the case that the political panorama in the world favours fossil fuel deal making, and we absolutely have a US administration which is in favour of that, and full-throated support for those kind of liquefaction investments and for deal making in natural gas. So I think that's a part of it. So these guys are kind of cashing in on the political moment that supports US LNG. Plus, everybody gets a bonus, right? When you take FID, that unlocks finance, and a lot of the guys who are leading these big LNG companies, they'll get bonuses, they'll unlock fees, they'll unlock development fees when FID is taken. So they are, all gunning to do that, because that's their paycheck, isn't it? They get stock options as well. They can sell their stock down the line if they get a nice share bump. Although notably, Next Decade suffered another share price wobble after it took FID on Train 4, presumably because the terms of the finance were not particularly favourable to existing shareholders. So buyer beware, I'd say. And that holds true across this whole kind of investment wave. I think it is very much caveat emptor if you're looking to get involved at this late stage in the investment cycle in an LNG investment, or you're looking to off-take volumes at a price that makes a high cost base project economic, then you are inviting trouble upon yourself. And why do I say that? Well, because the market's going to turn, and as you go up, all the most competitive projects take FID first. There is a merit order to these things. An LNG project that is taking FID now, having followed all the other ones, is not going to be the most lowest cost base, most economic project. Is going to have to sell their LNG at prices that are maybe slightly higher, incrementally higher than projects that are already further ahead in the development phase. So what does that mean? Well, if you're exposed to market pricing, and if you're a US LNG offtaker, then you almost certainly are, then when the prices come down and the cost base remains the same on that project, then what happens? Your margins get crushed. So if you look at the forward price of TTF, the Dutch title transfer facility, which is the benchmark European gas price, look at the future price of TTF in 2027, 2028, and you look at the forward price of Henry Hub, which is the cost base for gas, which is liquefied on the US Gulf Coast, and the cost of liquefaction, and you add on the cost of shipping the gas over the Atlantic and regasifying it in a European terminal, then you're going to see a convergence, right? So the delivered cost of US LNG in Europe is going to be about the same as the hub price of LNG, of natural gas traded on Henry Hub in sort of 2027, 2028. And that's before markets price in the kind of full wave of supply that's coming down the line. And that's significant because I think that the markets are adding a kind of non-delivery risk premium of pricing, because they know that, like some projects, they will not be built. There'll be delays, there'll be problems down the line. Many things could happen. Cost inflation was actually one of the themes discussed in some of the sessions, and I think even Venture Global mentioned that as an issue, that the cost of raw materials is going up, and if you have a project that's only marginally profitable and then your cost base doubles, which we saw post-COVID with like wind farms and LNG projects, and all sorts of commodities became more expensive and building stuff became more expensive, and that's still a problem. Inflation is a problem, so if you have more expensive materials, and plus there could be a labour shortage on the US Gulf Coast, so it can be difficult to marshal the number of workers into building these projects when they need to be built. So there are those constraints upon construction and things that can drive up the cost base. But if you're taking gas that's has a very high cost base, and then you're able to sell it above market rates, then you might find that these cargoes are going to be unprofitable. You take the cargo at a certain price, you want to sell it into an end market. Well, you want to be able to make a margin on that after paying for the gas, the liquefaction, the shipping, the regasification, and make some profit, right? There's got to be a little bit left over. That's not going to happen because if the spreads compress in the way that the futures markets are already pricing in, and I think that you're going to see further, much deeper compression of those transatlantic spreads. You're going to see cargoes at sea, which will be essentially unprofitable or marginally profitable. And in the past, there have been times when you can sort of float a cargo from, say, August until October and benefit from an uptick in winter pricing. That's like kind of playing the time spread, using an LNG vessel as floating storage to capture higher prices in higher demand periods. I think that play is going to be really tricky, because if the spreads are flat, and we've already seen very flat spreads, seasonal spreads in recent years, and I think that's going to continue, then you're going to have an LNG vessel sitting out like in the Bay of Biscay, boiling off, because that's what it does. LNG boils off. It needs to be recaptured, reliquefied, and used for propulsion or put back into the cryogenic tank. But if you're kind of boiling off value for weeks or months at a time, there's no play to be had there. If the spreads are flat, you can't get a higher price. So you're going to see, I predict, we are going to see distressed LNG cargoes at sea in the depths of the glut. Cargoes that simply can't be resold for a profit. So you've got to ask the question, what's going to happen to pricing? And I think the really important price to keep an eye on is not just the TTF itself, but also the price of LNG on the water, because that's where the glut is going to occur, on the water. Like TTF is important, and it is a reference, and it will come down with excess LNG production, but there will be, once there's kind of more LNG on the water than there is now, you're going to see competition for regasification slots in Europe. And when that happens, then not every vessel will be able to dock. So where's the pinch point on the regas? The regas terminals will be happy because they'll be having very high utilization rates, they'll be earning lots of money, but the LNG vessels themselves at sea that can't dock or have to wait, they're going to be like kind of burning off value, and you're going to see some distressed pricing there. Where will we see that manifest? In the Northwest Europe LNG price. So there is actually a different price for LNG in Northwest Europe compared to TTF. It's very closely correlated, especially when there's kind of excess regas capacity, then the price of LNG on the water is very similar to the price of TTF. But I think you're going to see a big dislocation between the two, because if the regas terminals are full, and there's more LNG on the water that can actually get through the regasification bottleneck, then the price of LNG on the water will fall. TTF will be falling too because there'll be lots of supply, but I think the Northwest Europe LNG price will fall even further. And so keep an eye on that dislocation between Northwest Europe and the TTF, because your one is on your like two price indexes on either side of the regasification bottleneck. So that's something I'll be tracking very closely in Energy Flux over the coming years, and yeah, that's one prediction I have. The other one I have relates to the domestic US market. Now, this kind of comes back to the political question and the duo of Wright and Burgum who stood in front of the press conference yesterday, and one of the questions was along the lines of, and this is a question I've been asking myself for many years, what are you politicians going to say to your MAGA base, the Make America Great Again, America First patriots, right, who don't want to give away American value to help overseas allies? They want everything for America, America first. What are you going to say to those guys if and when, I say if because it might not happen, but if and when the domestic price of American natural gas and therefore electricity and broader energy prices spike because the market's been tightened by a kind of uptick in demand coming from LNG exports, AI, data centers that need a huge amount of electricity to run, plus you have pipeline exports to Mexico, to Canada, all of which, in certain scenarios could make the American domestic natural gas price spike, or at least rise sharply from where it is currently, around about $3 per MMBTU. If that doubles up to sort of 5, 6, then that's going to manifest in much higher retail prices. And retail prices have already been rising for a long time for households and industrial consumers. They get a lot of differentiation between the states, but on the whole, the trend is upwards, a lot of cost inflation. And my prediction for the next sort of 3 years, around about the time of the next presidential election, actually, is that you're going to see an almighty bun fight between different vested interests over who can apportion blame for high energy costs in the US. And there's going to be some people pointing the finger at LNG, some at AI data centers, some at the regulator, some at the utilities for failing to invest in grid. It's going to be just an unedifying kind of lobbying fest. And you've got to question, well, where is the blame going to land? And it's very easy to see LNG exports as falling foul of the MAGA vision. They're not compatible, is it? You've been exporting all of our freedom molecules to those allies overseas who we don't care about anymore. We don't care about transatlantic alliances. Why are we bailing out Europe so that they can, not have to buy Russian gas? The Ukraine's not our war. Why are we paying more on our energy bills so that we can help people in faraway places? It's going to be hard for presumably J.D. Vance, who will run to replace Trump, to kind of appease the MAGA core if he's seen as having kind of screwed them over basically by making their energy much more expensive, or making industrial output less competitive with higher energy costs, and therefore resulting in layoffs, combined of course with the Trump administration's insane tariff policy, its trade policy, all these things that it's done to essentially reduce the standing and competitiveness of America Inc. on the global stage. So they have all these things to answer for. So I think there's a kind of political warning or risk attached to the US LNG export bonanza, because it really is a bonanza. It's just this absolutely massive supply wave coming down the line. So yeah, you've got the domestic American gas price question, and then there's the kind of price dislocation of like distressed cargoes on the water. Well, I think if push comes to shove, if the domestic American market becomes really hot, really overheated, then what's going to happen? I don't think it matters who is in the White House. If it means that they're going to be fighting fires at home and it will improve their popularity, then any president will simply issue an executive order and reduce or even cap US LNG exports, because that is kind of very low on the domestic priority pecking order, isn't it really? And if you bear in mind that the contracts that support US LNG are take or pay contracts, then you might actually find that the investors in the plants themselves might be protected from executive order, decree limiting the exports of US LNG to overseas customers. Because if they can say, well, look, to their buyers, that is, they can say, look, you're still on the hook for your liquefaction fee, then they're still making their money, and the customers are the ones that lose out. So the off-takers of US LNG, many of whom will be European utilities suppliers, maybe even industrial companies, are paying for gas that they cannot lift, but which would have been profitable potentially. That would be a real disaster for US LNG off-takers, and you've got to ask if they're exposing themselves to that risk, that kind of political, economic risk, by sort of going long on US LNG at this stage in the market. Remains to be seen. There's a big debate about the lower 48 states, their ability to increase production from the shale gas fields of the Permian Basin and other shale plays. The Energy Secretary Chris Wright was just categorical that there's no geological risk associated with the upstream. The shale production is essentially infinite, and that when there's demand, there is investment into the upstream and more gas comes, and we're so innovative and you can squeeze more energy out of every single square metre of shale resource. And he might be right. We'll see. But the decline rates on shale fields and some of the kind of mood music coming out of the upstream crowd in the shale patch doesn't always support that view. History is on Chris Wright's side. I mean, the shale boom has just changed the world. It changed the world, it changed Europe, it changed America, it changed the whole energy system. So you can't discount human innovation. So I'm cautious, but cautious not to be overly cautious, if you like. But at the same time, the decline rates concern me, and I think that the sheer volume of feed gas that's needed to feed these greenfield LNG projects is such that, is it going to be there? Is the feed gas going to be there, and if so, at what price? Because if all the prime acreage is being drilled out, then again you're looking at merit order economics, the merit order of natural gas coming out of the ground, being drilled out from second or third tier shale acreage. It might not be as cheap as it is currently, because let's just think back to the history of LNG, right? Think about the history of LNG. What was it used for originally? Well, often there was a lot of trapped gas, so associated gas coming out of the ground with oil. What do we do with it? Flare it off. LNG came along, was actually a big solution to flaring originally. So like places like Nigeria, which Nigeria still flares a lot of gas, let's be clear, but they did reduce their flaring from an even higher level by using LNG, producing LNG with it. So it was like this kind of free resource, let's monetize this free resource, and put a train down for like 20, 30 years. When the oil field depletes, then the gas runs out, and that's fine. We just pack up, we made our money, infrastructure did its job, and we exported LNG rather than flaring off all of that gas. So it's kind of it's an improvement on a very bad situation. But the LNG projects that are being developed now are different. These are not LNG projects that are tapping into a kind of discrete resource. They are requiring additional gas. Some of them will just draw gas out the grid, pay the going rate on Henry Hub, or they might have some sort of supply agreement with an upstream producer, but it's not integrated to the plant. It's not like going to Papua New Guinea and you've got a kind of isolated gas field there and you just plug in your liquefaction train, liquefy it, export it, everybody's happy. No, this is like along the Gulf Coast, one of the most industrialized parts of America, which has a very developed natural gas network, pipelines and things, all connected to upstream fields. But it's like, how much of this liquefaction capacity is going to be in competition with other uses of that gas, like basically drawing gas out of the gas grid? And I don't know the answer, frankly, but people are telling me that this is a big risk, that when the US LNG boom comes into having to compete for molecules in the upstream, then we might see much more expensive Henry Hub pricing, and then all the problems that I described earlier. So that's the way I see the LNG trends unfolding over the coming years. Those are some of the themes I picked up from coming to Gastech. It was well worth being here. It was an intense week of networking and chatting and long conversations with very knowledgeable people, and kind of drifting in and out of conference sessions that were very interesting. And of course I got to present myself. I'll do a separate episode about my presentation. I'll share my slides and talk more about those themes, which are quite separate to the kind of whole LNG outlook which I've just given. But yeah, like presenting at Gastech was a real buzz. It was a real buzz. I was very nervous, but I think it went all right. And I think it went very well. It went very well. And I got lots of compliments afterwards. And I even met some of my subscribers, which was brilliant. And I must do more of that. I must meet more of the Energy Flux readers, because there are so many interesting, diverse, intelligent people who read it, and who engage with me and help me with my knowledge of this industry. So but shout out to all of the Energy Flux people who are here at Gastech and who came up to say hi. Thank you guys. Yeah, let's just keep going, keep watching these markets. It's going to get very, very interesting over the coming years. Right, I think we're going to call it a day. Gastech's calling it a day. Everything's being taken down. I've got a flight to catch. Thank you for listening and watching, and I'll see you soon.